Hello and welcome again to my show, Searching for Integrity. My name really is John Smith. I'm searching for people with integrity because our country suffers from IDD, integrity deficit disorder. We have today David Hay, Mr. David Hay, and he is the co-investor with the equity company. And so now you can tell us all about it, David.
Well, John, first I would say it's a good thing you're not trying to recruit anybody in Washington, D.C. for this show. I think you'd have a really tough time coming up with a single person. But I appreciate being invited to be on such a prestigious show. And I am the co-chief investment officer, I want to emphasize the co part of it, of Evergreen Gavekal, which is a money management firm based in Bellevue, Washington, but with offices up and down the left coast, as I like to call it. But we're also partnered with Gavekal Research, hence the other part of the name, which is one of the most prestigious macroeconomic research firms on the planet. Many top money managers, most top money managers are clients of Gavekal. Louis Gav, Charles Gav, Anatole Koletsky, they're pretty famous guys, so I'm lucky to call them partners. And Louis is almost like family to me. So with that as a brief background, we are money managers. I do write a newsletter as well that's free. I always say that's everybody's favorite price. It's the Making Hay Monday that goes out on almost all Mondays, unless there's a holiday, then it's Making Hay Almost Monday on a Tuesday. And your listeners can get that by going to Substack and Haymaker. So that's my little avatar in the background here with the boxing gloves, because it seems like I'm always throwing punches at some crazy idea or inflated ego in our business, or particularly in Congress. So beyond that, I'm an author. I wrote the book Bubble 3.0, which was about the third bubble of the last 25 years, which I believe was the biggest. The first, of course, was tech. The second was housing. And the third was almost everything. So hopefully that's enough of an intro.
Right. I see the board behind you that says Haymaker, and I can see a couple of red gloves ready to go at it. Always
in a fighting stance when it comes to people lacking in integrity and full of hypocrisy. And I have no shortage of targets, let me tell you. Including a beloved central bank, I might add, the Fed.
Yeah. I've got a lot of people that don't think that the Feds are going to take us out of this. It's just going to let it roll on down off the cliff. What do you think?
Well, I don't think they'll do that. I think what they'll do when push comes to shove, and I think they've got to be pushed and shoved more than they have been so far, is I think they'll restart their magical money machine. That's what I call it anyway. The first iteration was quantitative easing, QE1, then there was QE2, QE3, all those ocean liners, things that sounded like ocean liners. But they floated the whole system on a sea of liquidity. And then, of course, during COVID, they went into full MMT, modern monetary theory mode, despite the fact that Jay Powell had previously derided that as basically a foolish exercise, which it turned out to be. But he did it anyway, or at least he enabled it in a huge way. So it's, I personally believe the Fed deserves a tremendous amount of blame for the position that we're in. If you think about where this country was a little over 20 years ago, we were running big surpluses to the point that Alan Greenspan predicted or feared that we were going to have no treasury bond market by 2010. I don't know if you know that, but I even have the article of that. I just came across it again here the other day. And I remember thinking, are you nuts? I mean, I know you're the oracle or the maestro really at that point, but the idea that we wouldn't have recessions, we wouldn't have wars. I mean, it was just, of course, it turned out to be the exact opposite of that. And now we're absolutely collapsing under this massive debt load that we've accumulated. So Jeff Gundlach, I don't know if you know him, John, but he's considered to be the new king of bonds. He's replaced Bill Gross from PIMCO. Bill's now retired. But Gundlach says, let's get rid of the Fed. Let's just let the 2-year T-note set the price of money. Mm-hmm. And I think he's got a great point.
Do you think that as you're looking out and anticipating, do you think that people get enough of your book, the Bubble 3.0, to help them decisions, or is that just help them to call up the phone and take care of my money.
I hope so. I mean, there is a section in there where I really go into what I think are the best strategies to deal with this new paradigm or this new world disorder, if you will. Now the book is available, on Awsound and audio form. And, unfortunately, if anybody listening here knows a financial publisher that might be interested in a book that actually predicted the demise of Bubble 3.0 before it happened, you would think there'd be some publishers out there, but we've been trying hard, so we had to self-publish. And so if somebody wants a hard copy, have them just email me. You can get me at David Hayes, Substack, Haymaker. So Haymaker at Substack, we'll send them a free copy. If anybody really wants to read it, I'd be glad to get it to them. But there are a lot of prescriptive sections in that book. And so far, they've worked pretty well. Now, again, this is going back over a year ago where one of the main predictions I made in early 2022 was that the balanced portfolio, which had served investors for so well for so long, was actually going to disappoint in a big way. The people would lose money on both stocks and bonds. And guess what? 2022 turned out to be the worst year for balanced portfolios since 1871, 150 years. So that was, didn't get them all perfectly right. One that I got wrong was the dollar. I thought the dollar would go down, and it almost immediately went straight up. And once again, it's under pressure, and it's this whole big theme, which maybe you want to talk about, de-dollarization is emerging, but that certainly is in the whiff column. But as far as most of the major predictions, especially balanced portfolio and energy, because energy was one of my very strong recommendations in that book, and energy had a fabulous year last year when almost everything was down. So overall, I feel pretty good about the guidance that I gave in that.
Well, the name of the book, Bubble, it has for those that don't know what a bubble is, that really it has a bubble in it, who blew it, and how to protect yourself when it blows apart. There have been a few of those in my lifetime that I walked through, saw through, and now we've got more. And not necessarily if we've got the people. It's quite an endeavor, to get up and say, well, is my goods still goods? Do people still believe? And if not, I go to work.
Yes, I think the bottom line is that, as we've already seen so far this decade, this is likely to be a very different decade than the last 40 years. But I guess you could say 2000, 2009 was not exactly a walk in the park either for financial assets. And even that decade, which was not that long ago, was one where if you had recognized the extreme overvaluation that we had going into the first part of this century millennium, and you moved away from financial assets and into more hard assets.
Right.
I mean, gold had a terrific decade. Energy had a very good decade. I think we're in a decade like that, or like the 1970s. But most people are not prepared for that. Most people are heavily exposed to these handful of great companies, for sure, like Microsoft and Apple and Google and Amazon and a few others. But you may note this, John, that in the first quarter when the S&P was up 70%, 95% of that return rather came from 10 stocks, 90% of the return came from 5 stocks. So, you've been around, that, that's what I'd call acute market halitosis, very bad breath. That's not a good sign, that narrowness of leadership. So, and I think what you're seeing is a number of the formerly star cyclical companies that are now starting to come under pressure. That were some of these steel companies like Nucor, Steel Dynamics, that were stars, are now getting hit hard. I think we are starting to discount a recession, which I do believe, and what seems to be absolutely 100%, is an earnings recession is already a done deal, which is 2 quarters in a row of falling earnings. And I think it's actually been more than that, but I don't know if we want to get into the weeds.
Now, are you across from A to Z? Do you have certain industries that you favor?
Well, yes, we do have certain industries we favor. We can pretty much go anywhere, John. We do individual securities, we do ETFs, we do international markets, we do domestic. We've got a big research team between ourselves and Gavekal. Between the two of us, we manage about $8 billion, and it's mostly non-indexed. We do have some index vehicles, but even the index vehicles all have a contrarian slant to them. and I won't bore you with the details there, but the bottom line is that we do intensive research. We're kind of dinosaurs in that way. So many of our competitors don't do individual security analysis. We'll go anywhere in the capital structure. I think our core advantage is our ability to manage income portfolios.
Mhm.
And our income numbers over the years have been extremely strong.
Do you think that credit growth is built into economic growth now?
Well, I think the two are inextricably linked, yes. I think it's almost impossible to get strong economic growth if you're in a credit contraction phase, which I think we are. In fact, 2/3 of banks are reporting falling loan demand right now, and deposits are falling at the most rapid clip in 40 years. It's almost unprecedented what we're seeing with deposits. And of course, that's a function of this recent banking crisis where SVB Financial went down, Signature Bank went down, First Republic's fighting for its life. A bunch of other banks are on the ropes, Credit Suisse, shotgun marriage to UBS. And that all happened in rapid succession, kind of an eerie reminder of what happened back in 2008. So yes, I think that's happening. And one thing that isn't getting the attention that I think it deserves is the implications for velocity, the money velocity, which is hugely important. And one of the most sacrosanct theories in finance was created by Irving Fisher back in, I think, the 1920s, which is M times V equals P times Q. What that means in English is money supply times velocity equals price times quantity. So price times quantity is basically nominal GDP. It's basically economic activity. So that's driven by the money supply, which is contracting. It's contracting at an alarming rate. It's fallen 2.4% in the last 12 months, almost unprecedented that's happening. Now velocity is declining because money's moving, as we see in the paper every day, from bank deposits into government securities. When money's in bank deposits, you have the multiplier effect at work. It can be multiplied tenfold. But once it goes from the banking deposit status into government securities, that money becomes largely inert. So this is a huge development. Very few people, Mike Wilson at Morgan Stanley, who I think is brilliant, is on this. Christopher Wood from Greed and Fear, also brilliant, Jeffrey's company or unit, he's on this, but very few other people are talking about this. Is a huge deal. And I think it's just being greatly underappreciated. End of sermon.
Well, I think people need sermons in order for them to be successful. And I'm aware of Mike Wilson. I have a high regard of him, just watching on the TV.
It takes a lot of heat for telling the truth.
That's true. And I could detect that early on when I first sat down to listen to him. And, the guys that kind of beat him up from, CNBC, that type of thing. Anyway, that's just how it is. Of course, credit growth is what has rumbled and bumbled the economic growth. It drives it. And we're about to reach a point, I think, that maybe it's not going to be there anymore. There's not going to be enough credit for the.
I totally agree. And
Yeah.
you can see that with small business lending standards have tightened drastically. There are really strangulation levels right now. And small businesses are basically the life of the economy. So it just all fits together that the banks are under pressure. So the banks are going to lend less. And when the banks lend less, the economy struggles, then you start getting layoffs. And one of the things that's amazing is you look at the unemployment numbers and they still look really good. I mean, it's low unemployment, a lot of job openings. I think there's double, triple counting with some of those job openings, but only time will tell for sure. But yet we see these layoffs. I mean, even McDonald's is laying people off. So exactly. We see these mass layoffs, and yet we hear the labor market is very tight. But I just think, the economy is showing more and more signs of recession. I just looked at a chart today, the composite of the 10 leading economic indicators. It just hit -7.5. If you go back to 1960, every time it gets down to -7.5, we're in recession, or we will be very, very soon. The yield curve is inverted. It's deeply inverted. Every deeply inverted yield curve has led to recession. People, once again, are blowing it off and saying, no big deal. But you know what? The inverted yield curve is a lot of why we just had this banking crisis. And I think it still has further to go, by the way. And it's because the banks are in the business to borrow short and lend long. And when the short rates go above the long rates, which is the inverted yield curve, it crushes the bank business model. And that's what happened to these guys. So once the depositors got wind that, hey, my bank may be bust, they take their money out, and then it forces them to sell the government bonds that they had in their hold to maturity category. I mean, Chris Whalen is a brilliant guy, probably tracks the banking industry better than anybody. And he said that as of the end of last year, even JP Morgan, if you marked their loan book and their investment portfolio and the real estate to market, even it had a negative equity. I'm just relaying what he said, but it's true that if you adjust these balance sheets for the loan losses at these levels and security losses, it isn't a pretty picture. Now, will they get through it? Yeah, I mean, the Fed's got all kinds of abilities to get them. That's what they're doing. They're expanding their balance sheet again, but they're doing it through the discount window with bank lending, and they are charging a good interest rate for it. So that's good for taxpayers anyway. It's not a free money for the banks by any means.
What do you think about gold? You think gold is going to go higher as a result of all this?
I do. I worry a little bit that this de-dollarization talk has become so popular, and gold has had a big boom. Now, it's not in the headlines. That's the good news. And you're not seeing gold and silver ads all the time on CNBC. You're actually still seeing outflows out of the gold ETF. So that's encouraging. So long term, I think gold goes higher. I just worry that it's had a pretty good move here near term, especially the gold miners, which we put out a pretty good recommendation in our Making Hay Monday back in March that the GDX looked like an attractive buy. And it has had a nice move. But, we kind of have this, it's all kind of a barbell strategy with gold miners, is that we believe that at some point there's going to be really a parabolic move, but it's going to be jagged. So when we get these big rallies, we like to take some money off the table. We did a ton of that back in 2020, and that was a good thing to do because they pretty much topped out and went through a nasty correction. We did it in 2021. We did it in 2022. We're doing it again now. We're taking some profits off the table. But I will say that I do agree with people like Gary and Rosenzweig. They're some of the best on hard assets that I've ever come across. They're making an incredible case that gold could easily go to 10,000 by the end of the decade, if not before. And they look at it just as a function of how much money is in the system, how much fiat money has been created, and then relative to the availability of gold.
Well, I think that in my opinion, you're dealing in the right areas. Not that I'm any super duper person, and I look at what a recession is. The recession. When we got the recession, people are asking, when's the recession come? When does the recession go? And when can we go back to work? I don't know. And others have interest and a magic wand that they could look at and say, yeah, it's going to be in 3 months and 22 days.
Well, it's a good point. And I think you got to be modest and humble when it comes to forecasting things. I think it was Yogi Berra said that it's always tough to make predictions, especially about the future. And I think this time is even trickier in that regard because there's so many events that are happening and forces at play that we've never seen before. I mean, for example, it's what I call this great green energy transition, where we're trying to electrify the auto fleet globally almost overnight. And that is leading. This is actually the first chapter we published of Bubble 3.0 in late 2021 was on this topic that I call greenflation, that the conversion of green energy is quite inflationary because we're moving from very energy dense sources to much less energy dense sources. And we're starting to see this play out where these, the costs that are coming out of what it's going to take to convert over and to try to do it by 2030, 2035, and the shortages that are going to occur in things like copper and lithium. That's another area I'd really suggest people, get their research for free, Gehring and Rosenzweig, and read some of these, demand supply collisions that are going to happen, say with copper. And I personally think everybody should have copper in their portfolio. Freeport, FCX is a great way to play that. Cheap stock too. And I think everybody should have uranium. I think uranium is going to have a vertical move here. Clearly, nuclear power is in a renaissance like I don't think it's seen since the 60s and 70s, before 3 Mile Island and before Chernobyl and Fukushima. And you're now even seeing the Biden administration supporting small modular nuclear reactors, which I'm an investor in one of the more promising startups. I have a lot of confidence in humanity's ingenuity to come out with these much more efficient, and much more distributed. So you don't have to have this massive plant with transmission line. Transmission lines are a nightmare. That's going to be another Achilles heel, by the way, of the great green energy transition. You put up these solar farms and you put up these windmills, you got to get it to the power where the power is consumed. It's just almost impossible to build transmission lines anymore. So I think this great green energy transition is just full of holes.
Yeah, I agree completely. Most of the world's banks, and I've read this just recently, are predicting that the banks in the world are going to go bad. And it's just, most of the world's savings is the point about that. It's not like it's all in the US, it's all over the world. You see it just sitting here in the US or with US behind it.
No, I think it's very much of a global problem. And so I have two mega fears for this year, mega risks. One is the implosion of the global housing bubble, which was actually greater, is actually greater than it was in 2007. Prices went much, much higher, even in the United States, but especially in other countries. And it was a function of what I think was the main cause of the everything bubble, bubble 3.0, which was interest rates at absurd levels. And America wasn't even the worst offender, even though for a while Donald Trump wanted us to have negative yields. Fortunately, we didn't go there. The Fed wasn't that irresponsible. But in Europe, they did have negative yields. Negative yielding bonds got up to around $18 trillion. There were home buyers in Denmark that were getting paid to buy a home. They were getting paid on a mortgage. If you can imagine that, it's all just Alice in Wonderland through the looking glass stuff.
Mm-hmm.
And so what it did, of course, was it drove real estate values to insane levels. And now they're falling. And this is, every bubble pops. And the bigger the bubble, the worse the implosion. So some of these other real estate markets are looking very scary, and they are clearly deflating. Sweden's real estate housing market's down about 15%. This is going to be the third blow-up that Sweden's had in housing. But throughout a lot of the Nordic countries, that's the case. In Canada, Australia, New Zealand. And of course, we know what China went through. Now, China's, I think, ahead of everybody in having taken the pain of the bursting of their real estate bubble. But in America, commercial real estate, I think, is a huge problem. Office buildings are down 25% over the last year. And we're starting to see a flood of buildings being given back to their lenders. Even big companies like Blackstone are having to gate their real estate funds and default on properties they bought. And that's, 70% of commercial real estate loans are held by mid and small banks. So if commercial real estate is going through a severe bear market, which I think it is already, that's going to be a major problem for the banking system, even in America. And so it doesn't make sense to me with an S&P that's trading, fairly close to a high, and it's down a little bit, but not a lot.
Right. And I think you're right about that. And I always have in the last few minutes of the show to ask you and you can give my audience where they can go to find your books, where all these things are, newsletters and so forth.
Yeah, I think the newsletter is the easiest way. It's, as I say, it's free, and just go to Substack or Haymaker. Pretty easy to remember both of those. And you do need to subscribe to receive it. And we also do a highlight reel Haymaker on Friday, which is, so the first one is more of specific trading suggestions or macroeconomic analysis. Mm-hmm. And I think the one that we put out yesterday is actually pretty interesting, and anybody can get that by going to Substack at Haymaker. Mm-hmm. So that's the easiest way. And, the book, as I said, that's a sincere offer. If any of your listeners would like to get a copy of it, we'll just email us and we'll send it to that person.
Yeah, I got my copy by email yesterday. Thank you.
Well, you're welcome. You got the digital. We can also send you a hard copy, John, if you want that.
Well, I think I'm okay.
Well, good. It's cheaper for us. I like that.
Now, let's see. I want to thank you very much for being on the show.
You're welcome. Thank you for inviting me.
My people are interested in things such as this, and to think, if you will, how many are out there. And there's a lot, and they listen big time. And I'm glad to have a guy like you so that you can talk to people. And once they hear you, then they might be thinking about whether it's solid ground or not, or what, or mud.
Yeah, that's a good point, John, because I think there's a tendency when people see all the problems that are out there to go into kind of the fetal position, and I don't think that's the appropriate response. There's going to be some areas where there's a lot of money lost, but there's going to be some areas where a lot of money is made.
Mhm.
I just think that what people are in the habit of doing, based on the history of the last 40 years, is not the right positioning. I think they have to have a different mindset for the next few years. People kind of make fun of me when I say this, but I like to say I'm really bullish on the 2030s. I think we just have to get there, get through a lot of this stuff because of all these silly policies we've been doing for the last 25 years. But for those people that do position accordingly, I think it could be a pretty lucrative rest of the decade, much like it was in the 1970s and the first decade of the century. So thank you again, John. I appreciate the chance to chat with your folks.
Well, I'm glad you did, very much so. Thank you for being being a person that's knows what he's doing. That's the big help. And I tune into my searching for integrity. I like people to do that again. And I have my adios, so long, and happy trails to all until we meet again.